Hello everyone, welcome to Unit 4, Lecture 4. Today we will be covering regulators and pension funds. So first, who are the referees in the financial industry? So this is supplemental material to provide you a little bit of more information about who is overseeing the financial industry. So, who protects investors? In the same way that sports games have referees, the financial marketplace needs to have some type of oversight to make sure that unethical behavior does not harm investors. So, in the financial industry, there are three main types of these referees. First, there is the SEC. This is the Securities and Exchange Commission. Then we have there is a typo here. These are self-regulatory organizations, so SROs, and then there are other regulators. What we will be doing on the upcoming slides is detailing and providing a little bit more information about these three main types of financial industry referees. First, we have the SEC. So according to the SEC website, the mission of the U.S. Securities and Exchange Commission is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. So that would be in regards to raising new capital through stock and bond issuance. The SEC oversees the key participants in the securities world. These key participants include securities exchanges, securities brokers and dealers, investment advisors, and mutual funds. And the SEC is concerned primarily with promoting the disclosure of important market-related information, maintaining fair dealing, and protecting against fraud. So, for example, all publicly traded companies must register with the SEC and then submit important documents, including the 10K, 10Q, 8K. You can find these different documents by going to edgar.com. That is where you can research the different documents that these publicly traded companies must file with the SEC. But that is the SEC, the Securities and Exchange Commission. The other referee would be SROs. So a self-regulatory organization, or commonly referred to as an SRO, is an organization that is formed to regulate certain professions or industries. So they are usually non-governmental organizations that exercise jurisdiction with the aim of putting up rules to promote order among businesses. One main example of an SRO is FINRA, the Financial Industry Regulatory Authority. They are dedicated to investor protection and market integrity through effective and efficient regulation of broker-dealers. It is a not-for-profit organization, which is what's key here is that it is authorized by Congress to protect America's investors by making sure the broker-dealer industry operates fairly and honestly. So if you have not played around or navigated the FINRA website, that might be something that would be of particular interest, just to kind of see some of the information that they are collecting on these different broker-dealers. Some other common SROs include the Chicago Board of Options Exchange, the CBOE, and the MSRB, the Municipal Securities Rulemaking Board. Lastly, some other regulators include the Department of the Treasury, the IRS, the Internal Revenue Service. We also have state regulators such as the North American Securities Administration Association, NASAA, the Federal Reserve, Securities Investor Protection Corporation, the SIPC, and then as we've mentioned previously when we've covered banks, the FDIC, the Federal Deposit Insurance Corporation. So why is this regulatory information important? Well, you all know that you are one of your assignments for this course is to complete the SIE exam. The SIE exam does cover regulators. That's one of the topics on this exam. And remember that this SIE exam is needed before taking the Series 7 exam. So you will see this information on upcoming exams if you ever have to take those examinations. So that is the first part. So who's overseeing the financial industry? The second part of this lecture deals with the basics of pension plans and insurance. So this material comes from chapters 18 and chapter 15 in your textbook. Learning objectives today, first to understand the basics of pensions. So we'll talk about defined benefit plans versus defined contribution plans, and then we'll also talk about IRAs. And then in lecture 5, we'll go into the basics of insurance, so ordinary life insurance and other insurance. First off, pensions. A pension defined is a regular payment made during a person's retirement from an investment fund to which that person or their employer has contributed during their working life. So this is something that is quite important as you enter the workforce to know what type of pension plans are available. As we go through the rest of today's lecture, you may want to have a calculator out as we will be doing some quantitative problems. But let's jump in and identify the different types of pension plans that are available. So there are two main types of pension funds. The first is a defined benefit pension fund. This is where the employer agrees to provide the employee with a specific cash benefit upon retirement, and it is based on a formula that considers the years of employment and the salary during employment. So this is something where once the employee retires, they would receive a check every year or maybe every month, but it's based on what your on some formula based on the number of years of employment and then your salary during employment. So for example, let's say an employer uses a final pay formula to determine their retirement payouts for its employees. Let's say the annual payout is 3%. I'm just going to verbally state this one, so hopefully you can still follow along. So the annual payout is 3% of the average salary over the employee's last 3 years of service times the number of total years employed. So let's calculate the annual benefit. Let's say that the employee works 25 years and their average salary over their last three years is $67,000. So under my example where the annual payout is 3% of the average salary over the employee's last 3 years of service times the number of years employed, the annual pension payment would end up being the $67,000 times 3% times the 25 years, or a payout of $50,250 per year. Now, the defined benefit pension fund was most prominent during our grandparents' time, where it was very common for an individual to work for the same company, and then your payout would be based on the number of years within that company. With a defined benefit pension fund, the employers are going to have to be able to set aside funds in order to have the necessary capital when their employees actually retire. Now, on the other hand, we have what the second type of main pension fund is a defined contribution pension fund. So, for example, like a 401k. This is where the employer contributes a specific amount to a pension fund during the employee's working years, and then the employee can also contribute. The beauty of this is that you can actually, if you change jobs, your plan can follow with you. So by the employer contributing a specific amount to a pension fund, they don't have to maintain the funds themselves. So basically what they're doing is they're putting the funds for their retirees into a pension fund, and they have basically washed their hands of having to handle this handle this investment. So what we'll do on the upcoming slides is do some examples of these. So first off, what we will be looking at is a defined benefit plan. So this is where the organization will have to maintain the funds. So in this example, we are going to look at this from the corporation's point of view. So here we have a defined benefit pension plan, has expected payouts of $12 million per year for 20 years. So they expect to have to pay $12 million per year to their retirees, a total of $288 million. Actuaries, and an actuary defined is a person who compiles and analyzes statistics and uses them to calculate insurance risks and premiums. So these actuaries have estimated that the fund can be expected to earn 5% on its assets, and the fund currently has reserves of $135,475,000. Is the plan overfunded or underfunded, and by how much? So we know they're going to have to pay $288 million total over the next 20 years. They currently have $135,475,000. Do they have additional funds in their account? Are they overfunded, or are they actually underfunded? So the solution for this is simply a series of finite equal payments. So basically what we have here is an annuity. We have $12 million payments for the next 20 years, and we need to compare what the present value is of those $12 million payments for the next 20 years to what their current account balance is of $135,475,000 to see if they have enough currently in their investment to cover that $12 million payments each year for the next 20 years. So essentially, all we're doing is solving for the present value of an annuity. So over the next 20 years, so I'm just going to draw a very basic timeline here, they are going to have to make $12 million payments per year to their retirees. We want to know what is the present value of these $12 million payments and compare it to what they currently have in their account, $135,475,000. So simply solving for the payment, we can use our financial calculator. So if you do have that, go ahead and get it out. Our payment each year is the $12 million. We're going to have to make this payment for 20 years. Our rate of return on this, what we believe we can earn on our assets with our current $135,475,000 is 5%. So that's what we will be using as our discount rate. The future value is 0 since we do not have an additional cash flow occurring at the end of the 20 years, just that $12 million payment. If we calculate the present value, we get a present value of $149,546,524. So that value is the present value of those $12 million payments. So does the pension fund or does the fund have enough money to meet these payments? Well, the pension funding is equal to the reserves minus, so the reserves basically being what you have minus the present value of the cash flows that you will be paying out, so what you need. And hopefully, as you can see, you are actually underfunded by over $14 million. So this isn't just a textbook example. This really is happening where these companies have these defined benefit plans and they have their reserves currently, and they are unable to make those generous pension payments that they initially entered into with their employees. Let's take a look at another example. Again, we have a defined benefit pension plan, has expected payouts of now $15 million per year for 25 years, so a total of $375 million will need to be paid out over the next 25 years. Again, actuaries have estimated that the fund can be expected to earn an average of 5.25% on its assets. The fund currently has reserves of $215 million plus. Is the plan overfunded or underfunded? So the same thing, we are solving for the present value of these $15 million payments for the next 25 years. So what we have is a constant cash flow each year, a finite level cash flow of $15 million each year for the next 25 years. We can earn 5.25% on our assets on our investment now, so that's what we use as our discount rate. We do not have an additional cash flow at the end of the 25 years. What is the present value of these cash flows? If you go ahead and calculate it, you'll get a present value of $206,212. So once again, pension funding is equal to your reserves. So what you have minus the present value of the expected cash flows, what you need. We have $215 million plus. We'll need $206 million plus. So hopefully you can see that we are actually overfunded here in this example by about $9 million. So that is a defined benefit plan where the organization is setting aside funds themselves and handling the investments themselves to make the payments to their retirees when they actually retire. As discussed previously, the other main type of pension plan is a defined contribution fund. So with a defined contribution pension fund, this is where the employer is making contributions to a pension plan. You can have a fixed income fund, which guarantees your rate of return. So maybe if you're risk averse, you'll go into a fixed income fund where you'll know what rate of return you're earning on your on the investment. Or you could also have a variable income fund. So this is a not guaranteed return. So for example, investing in the stock market, and it could be higher or lower based on the investment's performance. For private pension funds, so not state pension funds, the defined contribution pension funds are more popular in terms of the number of plans, fund assets, and also plan participants. And within this defined contribution pension plan, they oftentimes invest in mutual funds. So we discussed what a mutual fund was in Lecture 3. But with these defined contribution funds, oftentimes they are investing in mutual funds. Some additional plans are a 401k and a 403b. There are a lot of arguments that all businesses should offer a 401k. Well, what are they? 401ks and 403b plans are employer-sponsored plans in which the employee can reduce his or her taxable income by contributing with employer matching. So the employer is not required to match on these plans, but oftentimes most do. So what's the difference between a 401k and a 403b? A 401k are for employees of firms that pay taxes. 403bs are for employees of firms that do not pay taxes. So for example, hospitals and schools. So let's take a look at a 401k example. So now we're looking at it from the individual person, the individual's perspective. So let's say you want to have $2.2 million when you retire. So Where do we come up with this $2.2 million? Well, you would sit down with your financial advisor and try to identify what expenses you'll have during your retirement. The amount that you'll need would just simply be the present value of those expenses that you expect to incur while you're retired. So you want to have this $2.2 million when you retire and you are in a 401k plan. You can earn 4% per year on the money invested. So for example, here we have a fixed income plan. And you will retire in 45 years. Your employer also contributes to your plan, and the employer will contribute 1% of what you put into the plan each year. How much do you have to contribute per year to meet your goal? Now notice in real life there is typically a limit on how much of your income you can contribute. I just need to make sure that we state that here before we get into our example here. So this is a two-step problem. First, find out your total needed contribution. So this includes both from you and your employer. So what will you need to contribute each year to have that $2.2 million in your account in 45 years? And then we will find out how much you individually have to contribute. So once again, this is simply an annuity, where you are making a fixed payment each year for a finite period of years, and you want to figure out how long it's going to take for you to get, or you want to know what you'll have to contribute in order to have that $2.2 million at the end of the 45 years. So what are we solving for? We are solving for the payment. The $2.2 million is the future value that you'll need at the end of the 45 years. In step one, we just ignore the employer contribution. We want to know what is the total amount both between myself and the employer that we'll need to reach that $2.2 million. So simply solving for the payment of an annuity where the future value is the amount that we want to have when we retire. N represents the number of years until we retire, so 45 for our N. The IY is the rate of return, so if we 4% here, for example, could be your fixed income fund where you are expecting a 4% return per year. It's not the variable fund like investing in stocks where 1 year it could be a 15% return, 1 year it could be a negative 5% return. Present value is 0. We're starting at 0 in our 401k. We solve for payment, and our payment would be $18,177.40. This is the total needed contribution per year that you would have to contribute each year for the next 45 years if you can earn 4% on your investment in order to have $2.2 million in your account when you retire. So continuing, step 2 now is to figure out how much would I individually have to contribute. So what portion of this $18,177.40 will I have to contribute, and then what portion would then end up being contributed by my employer, who is matching at 1%. So your contribution plus your employer's contribution equals the total contribution. We know the total contribution is that $18,177.40. Let's go ahead and notate our contribution with the variable y. So we have our contribution y plus the employer matching 1%. So our contribution times 0.01, 1% in decimal form, is going to equal that total contribution of $18,177.40. We have a variable here that's being separated by an addition sign, so we need to take out that variable. It's assumed to have a 1 here in front of the y, so we take out the y and we break it down to have 1 plus 0.01 equals the $18,177.40. Divide both sides by 1.01, and we get our total contribution needing to be $17,997.43. So what we have is essentially, what is that? $180 is what our employer would be contributing, and we'd be contributing $17,997.43. If you're struggling with the algebra here on how I actually pulled out the y here for our total contribution, there's a shortcut. So your contribution is simply going to be equal to the payment divided by 1 plus your employer contribution in decimal. So notice that this is just simply this step here. We just went straight to the final step there, where it's the total contribution, the payment that needs to be made each year, divided by 1 plus however much the employer is contributing as a percentage of what your investment is. So once again, we have that same value, get to $17,997.43 that we would have to contribute. Our employer would be contributing the remaining difference to get to that $18,177.40 total annual contribution in order for us to have the $2.2 million when we retire. Let's take a look at another example. So same kind of scenario. We want to have now $3 million when we retire, and we are in a defined contribution plan. You can earn 6.5% per year on the money invested, and you will retire in 43 years. The employer also contributes to the plan, and they will contribute 3.5% of what you put into the plan each year. How much do you have to contribute per year to meet your goal? Once again, in real life, there's typically a limit on how much of your income you can actually contribute. Once again, a two-step solution. First, find out your needed contribution, or first find out the total needed contribution, so you and the employer, and then isolate how much you individually have to contribute. So step one, we are solving for a payment. We're at the end of the 43 years. We need to have $3 million, so that is our future value. N is the number of years until we retire, so 43. IY is the rate of return on our investment, so 6.5%, which was given. We start with 0 in our account. How much will I have to put in each year in order to get to that $3 million? Solve for the payment. We get $13,930.57. This is the total needed contribution. Now let's isolate and solve for how much we individually have to invest. So we're just going to go straight to the shortcut for the equation, which is your contribution is equal to that annual payment divided by 1 plus your employer contribution in decimal, which was 3.5%. So we take the $13,930.57 that we just solved for in step 1 and divide it by 1 plus 0.035, and we get our contribution amount being $13,459.49 per year. So that is our discussion on pension funds. Next up is IRAs. What is an IRA? An IRA is an individual retirement account, and these are self-directed, so these do not have employer contributions. So these are self-directed retirement accounts whose contributions are made solely by the employee. There's no employer matching, and most IRAs are invested in mutual funds. There is your traditional IRA, and then we'll discuss a Roth IRA. So here it says that $5,500 max can be contributed per year. This is actually slightly dated. In 2019, they actually increased this to be $6,000. Can be contributed per year for employee. An additional $6,000 can be contributed by non-working spouse. And the couple's adjusted gross income must be less than $188,000 for contribution to be tax deductible. So with an IRA, so this is something that you may have in addition to the pension funds that we discussed previously, so the defined benefit or the defined contribution, or the 401k or the 403b. This would be something that you could do in addition to those pension funds so that you could have additional savings for retirement. Now with IRAs are taxed at withdrawal, so you can have this contribution be tax deductible in the year of contribution, but then when you withdraw at retirement, that is when you are taxed on your investment. So you're taxed at withdrawal when you pull the funds out of your traditional IRA. Now, on the other hand, we also have a Roth IRA. A Roth IRA is taxed in the year of contribution, and the withdrawal is tax-free. So you're taxed on in the year of contribution, but when you withdraw, your withdrawal is tax-free. If funds are invested with some restrictions, so the funds must be invested at least 5 years, and the individual must be at least 59 and a half years old. A Roth IRA is only available to individuals or households whose income is less than $127,000 or $188,000 for the household. A Roth IRA would be something that would make sense if you expect your retirement tax bracket to be higher than your early years tax bracket. So you obtain that benefit of your withdrawal being tax-free in the higher years when you have a higher tax bracket. There's one rule of thumb that kind of says that if you have a long time frame until retirement, a Roth IRA would make more sense. But that is something that would definitely need to be considered when you're going back and forth between a traditional IRA and a Roth IRA as to which one would make most sense based on when you're taxed. Are you going to be taxed on your contribution like with a Roth IRA, or is it tax exempt and then you're taxed at withdrawal like a traditional IRA? Bottom line, a traditional IRA, the contribution is tax-free, but then the withdrawal is taxed. With a Roth IRA, your contribution is taxed, but the withdrawal is tax-free. So what we'll do to conclude here today is look at an example of why it's important to start saving for retirement as early as possible. And what we'll do is we'll look at it from the point of view of investing in these different IRAs to see what type of impact it has to begin earlier for your savings for retirement rather than later. Alright, so we will conclude today's lecture with an example of why it is important to begin saving in these retirement accounts as soon as possible. So, what we are going to do is look at an IRA contribution. We'll ignore any tax implications, so this could be a traditional IRA or a Roth IRA. But let's look at two strategies. Strategy 1, you save nothing from age 22 to age 43. Then you contribute the maximum amount of $6,000 each year from age 44 to age 65, and you retire at age 65. Strategy 2, you save half of the full contribution, so only $3,000 per year, but you begin at age 22 to age 43. Then you'll save nothing from age 44 to age 65. You retire at age 65. So both scenarios, you're retiring at the same age. One, you're contributing the maximum amount later on. The other, you're saving half of the maximum amount, and you're doing so at the beginning years. For those of you that are that kind of pay attention to this stuff, most of Americans end up starting their savings for their retirement plans well into their late 30s or mid 40s. So option 1 is much more prominent in today's society of beginning your savings for these investment or for these retirement accounts later on. But let's take a look here on what the implications or what the impact would be if you can actually begin to start these savings activities as early as possible. So here we have a rate of return on the investment of 4%. Which investment strategy would be better? Let's take a look at strategy 1. You invest nothing from ages 22 to age 44. 44, you contribute your first amount of $6,000, the maximum amount. And you do so, and you contribute $6,000 per year, and you continue to grow your investment, and you finish with a value of $205,488. Strategy 2, you contribute half of the amount of $3,000, and you do so for the first 22 years, and then you stop contributing. You're not adding anything additional into the account after the age of 44, but notice that your account continues to grow until the age of 65, where you retire. With strategy 2, you end up with a final value of $243,495. This is the power of compounding. So with strategy 1, you deposited a total of $132,000. So $6,000 per year for 22 years, you deposited a total of $132,000, whereas strategy 2 deposited half of that, $66,000. However, it is strategy 2 that finished with over $38,000 more in the ending balance by beginning early. So by investing early, you are able to reap these rewards of compound interest. So by contributing early rather than later, you are able to contribute less, but actually finish with more in your when you end up retiring. So this is something that I realize that you may not be thinking about retirement at your current life stage, but it is something to keep in mind as you enter the workforce, that the implications or the impact of beginning early and of starting to obtain that compound interest is something that could substantially help you later on when you are ready to retire. So what this does is conclude lecture 4 on the referees of the financial industry, and then also our discussion on pension plans. Don't forget to take or to complete your lecture 4 question on Connect, and I will talk to you all soon. Thanks.